Okay, here is working together for 4. We are working on our closing entries, and basically I'm not going to write numbers on this one. Again, more notes, important things to remember. So basically there are 4 closing entries that have to happen. And if you remember back to Accounting 1 and our lecture most recently with that group, closing entries are to get our temporary accounts down to 0. We're going to close them out because we don't want those kind of accounts to accumulate information from year to year, like all of our expenses. Okay, we don't even want our net income to accumulate. I mean, it does in retained earnings, but the idea that it's kind of, again, only as good as you've been this year. So what is your income for this year? What are the expenses for this year? Those kinds of things. The permanent accounts, those are your assets, your liability, your retained earnings. We don't want to zero out cash. We don't want to zero out accounts receivable because people owe us money. We're not going to zero that out. Our accounts payable don't zero out because we're going to owe people money. Okay? So really remember that it's income statement accounts that we need to close. And so again, the 4 entries to make this happen. And basically we're also transferring our net income into retained earnings with this whole process. Okay, so the 4 that we need to remember. Let me see if I can get these all up here in this heading space. All right, number 1, any income statement credit will close to income summary. General. Okay, remember when we had merchandise inventory, we had to use income summary for the adjustments. Okay, so those are labeled by department, where here, this is our general income summary account. Okay, number 2, any income statement debit will close to income summary general. Again, 3, we're going to close income summary general into retained earnings. Hopefully you can see that. And 4, any dividends into retained earnings. Okay, so those are the 4 entries we're going to make. All the last day of the month, the ending of the period. Okay, so on whatever the current year is, December, oh excuse me, can't do that just yet. I gotta write closing entries right here. Glad I switched to pencil. Okay, 2018, December 31. Step number 1. Close anything with a credit in the income statement to income summary. So really we need to go back to our worksheet and our adjusted trial balance. Again, we come back to this a lot. Okay, so we're starting here, okay, because this ends up being our income statement accounts from here down. We looked at that when we were trying to find the net income the first time. Anything with a credit. So here we start with one, income summary kitchen, sales kitchen, sales bath, all the way down. Okay? So we'll write all of these down. If they're a credit now, we have to get them to zero. Well, if we need to zero this amount out as a credit, we have to debit that same account. Okay? So we'll take all of these accounts, again starting with income summary kitchen. Okay, and if it was a credit in our adjusted trial balance, it's going to be a debit. So 6194, 62. Okay. So keep going down that list, and we end up right here with our income summary general. Okay, and this is going to be our credit. These are all going to be my debit, and these are income statement credit accounts, credit balances, really I should say. Income statement accounts, let's do that. Income statement accounts with credit balances. Okay. So there'll be that whole list there. Okay. All right, then, so that's number one. Number two. Also on the 31st, any income statement debit needs to be closed into income summary general. So in this case, if they're all debits, they have to be closed with the credit. And then income summary needs the debit. And we always want the debit to happen first. So we're going to go ahead and write income summary right here for the general. Okay, and that amount will go right there. We're actually going to not put anything there just yet. Okay, and then we'll start listing all of those accounts that have the debit balance that we're closing with a credit. Okay, so I'll just do the first one, income summary bath. And if you indent a little bit, that helps keep things visually straight. And that amount is 94869. Okay, and so that will be all of the income statement accounts with a debit balance. Okay, and this will be a long list. Actually, it's going to go all the way down. Got it marked here. Okay, and it'll be all of these because they all had debit balances. Now we're all getting them down to zero with a credit. Okay. All right, then that gives us a number. It gives us a credit in income summary general, and it gives us a debit in income summary general. And the difference between these two is your net income. Okay? So I don't know if you want to write that down somewhere or mark it, but basically income summary general credit minus debit equals net income, and that's going to get transferred to retained earnings. Okay? So now what we're going to do is our third transaction, which is to take income summary and close it to retained earnings. Okay? So here we have credit minus debit. As long as you have net income and not a loss, your credit's going to be the larger amount. So you're going to have a credit balance income summary. Income summary does not have a normal balance side. It just depends on whether you have net income, net loss. Okay? So credit means you have net income. If you had a debit balance, that would be a net loss. Okay? All right, so here we definitely have net income. Our credit's bigger. So if we have a credit balance and we have to close it, we have to debit income summary and credit retained earnings. Okay, so our next transaction on the 31st, bring this back here. Income summary general is our debit, and retained earnings is our credit. And remember, retained earnings is owner's equity. Owner's equity has a credit increasing side, normal balance. So if you're crediting retained earnings, that means you're adding to your capital. You're adding to the value of your company, and that's good. That's what we want to see. All right, and then the last one is dividends into retained earnings. And so in our sole proprietorship, that was always drawing, the owner's drawing account, okay? What the owner withdrew. Well, basically with dividends, it's the owners getting money out of the business because they're getting dividends. And so it's the same activity, same action. Okay? So again, dividends, if we look at our adjusted trial balance, here's our dividends. Now this one's not necessarily income statement, right? But that was really the first two transactions. So here's our $16,000 debit. If we need to zero this out, we've got to credit dividends. We credit dividends, we have to debit first, and we're debiting retained earnings. And crediting dividends. And that gets all of the counts that we need down to 0. Our net income has been transferred to the owners as retained earning, or to the company's account with retained earnings. And those are your closing entries for a corporation. Okay. Oh, I do want to make this one more note. Just because we've talked a lot about, and I mentioned it, but let's write it down. Okay, retained earnings is like capital. Okay, where dividends act like drawing. We're going back to accounting 1, thinking about capital, drawing, all that good stuff. Okay, so here's you a notes page. Again, this is the important part, remembering these 4 steps in closing entries, these 4 entries. And then, again, all of this information came from our worksheet, our adjusted trial balance. And that's a good reminder that how important it is to get all of those numbers right on that worksheet. So, all right.